Hey VV Nation, what's going on? It's Patrick here at VectorVest, and today at 2 p.m. the Fed just released their minutes on what their plans are going forward. And so to help you guys out there who don't have a lot of time, I'm going to give you the quick synopsis of what's going on. And then as always, we'll finish off taking a look at what the markets are doing now after the minutes have been released and see how they're reacting. So if you're ready to get updated on what the Fed is planning, make sure to hit that like button, subscribe if you're not already subscribed, and let's jump right into it. Alright, welcome back and let's jump right into it here. So first and foremost, the Fed starts off talking about COVID and still being the number one threat to the recovery since the pandemic started. They talk about how with vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen, but unfortunately, because of the increase we had with the COVID-19 cases over the summer, we're still seeing that recovery being very slow at this time. They also go on to talk about inflation, and inflation is elevated, largely reflecting factors that are expected to be transitory. So the Fed seems to be doubling down on their claim that inflation that we currently see right now is only transitory and mainly due to the impact of the economy starting to come back, global economy starting to come back, but you still have a lot of imbalances with the supply chains here. Then as we scroll down, getting into some of the main important parts, they're talking about their interest rates and inflation rates of running lower than that 2% target that they've set for themselves for quite some time. And then they go down into the second page here, talking about what their plan is moving forward. So in their plan, they talk about, in light of substantial further progress the economy has made towards the committee's goal since last December, the committee decided to begin reducing the monthly pace of its net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. So they've announced officially that they are going to start tapering at the end of the month. They're going to slowly cut back on how much they're purchasing or their quantitative easing. They're basically slowing that down. And their estimate is to have it all completely ended by the middle of next year or 2022. They also don't talk about raising interest rates at all, so that is still a guess. But if you look at the bonds, you look at the yields, they do start showing some signs that people are expecting them now to start picking up sometime in the middle of 2022, most likely when the bond purchasing or quantitative easing starts to come to an end. But in this report, they also talk about how even though they are going to start tapering on their bond or asset purchasing, that isn't a direct correlation to raising interest rates. So they still talk about how having near zero short-term interest rates that we currently are in, or the environment that we're currently in, is helpful to speed up the recovery for the job impacts that we're still feeling. There's still a deficit of about 5 million jobs currently on the unemployment rate. So for the time being, while the economy is starting to recover, they're basically going to slow down on their quantitative easing, but keep rates near zero to help that employment aspect, which is part of what the Fed's main job is to do, which is to control the money supply and also keep unemployment at the most optimal pace possible. Now, with all that being said, they did leave some wiggle room for themselves or some possibilities that, depending on how the recovery continues to progress, they could make changes along the way. So as always, we're going to be focusing on December at their next FOMC meeting and see if they have made any changes or if they're starting to think that they may need to start making changes as well. But so far with the way the Fed has handled this whole situation, they've been announcing their plans well ahead of time to give the market some time to digest that information and make sure that they're comfortable with it before they actually start acting. So that's exactly what you want to see from the Fed. You don't want any surprises coming from the Federal Reserve. All right, so that's really the main gist of what the Fed has to say in their minutes here today. Now, let's go ahead, jump into the software, and take a look at the major indices and see how they're reacting from this news. All right, so now that we're in here, what we're going to do is we're going to take a look at all the major indices, so the Dow, the Nasdaq, the S&P, and the Russell, and we're going to use their ETF equivalents to get an idea of how they're reacting here today, since they tend to move at a 1-to-1 rate. Starting off with the S&P 500. As we can see, things seem to be pretty good. most likely what we're seeing here is that the market has already anticipated this, which is no surprise. And this taper that they just announced that will start at the end of the month has already been baked in. So therefore, no surprises. Markets are reacting favorably. S&P 500 is continuing to move higher, hitting that new all-time high. Let's go take a look at the next, the Dow Jones. Dow is still underwater a little bit here today, but it's really about flat from where we opened up at. So no surprises. And if anything, after the high yesterday, this could just be a typical day. So therefore, the Dow's not really showing anything that shows weakness or shows concern for the time being. Let's move on to the next one. Looking at the Nasdaq. Now, the Nasdaq has been one of the biggest movers here so far for 2021 and has really been helping the market stay afloat. Well, initially we did see some nice pop from that Fed minute release at 2 p.m., but since that point we have been pulling back a little bit. The main thing, if you're focused on Nasdaq stocks or tech-heavy stocks, is the interest rate aspect of things. With near zero interest rates, the Nasdaq or those tech stocks tend to benefit the most with those conditions. So for right now with tapering, it doesn't seem to be affecting them too much, but if they start announcing that they plan on raising interest rates in the near future, that will be the catalyst that could send the QQQ or the Nasdaq lower here. So if you're following tech-heavy stocks, make sure to stay on top of that and be alert of that information there. And then last but not least, IWM for the Russell. Now, as I've talked about in plenty of other videos, the Russell tends to be more of that leading indice. The Russell is looking at the small cap stocks, 2,000 stocks in that index. And as we can see, they seem to be acting favorably to the news, blasting off, continuing to push higher, hitting that new high here as of today, trading a couple of cents below that, but nothing to worry about. So small caps seem to be benefiting from the news here today, and that's no surprise. Whenever you see the Russell starting to rise, that is usually an indication that investors out there are willing to take on a little bit more risk or more risk adverse. So this is a positive sign for what we could potentially see coming in the very near future for the major indices. So hopefully you guys enjoyed today's analysis. Hopefully you guys are all up to date with what's going on with the Fed, because that does have a direct impact on what happens here in the markets. So until next time, be safe out there, take care, and I'll see you guys in the next one.